Money? It's the fuel of our lives, the engine of our dreams. We chase it, we spend it, we worry about it. But how much do we really understand the forces that shape our financial decisions? It's deeply intertwined with our psychology, our emotions, and our very human nature. In this video, we're diving deep into the key lessons from Housel's groundbreaking book. Prepare to have your perceptions challenged as we explore the often surprising ways psychology influences our financial behaviors. We'll uncover the role of luck and risk in financial success, debunking the myth that wealth is solely the product of hard work and intelligence. Get ready to embrace the power of compounding, that magical force that turns small, consistent investments into substantial wealth over time. But it's not all about numbers and graphs. We'll delve into the profound relationship between money and freedom, exploring how financial stability can empower us to live life on our own terms. We'll also tackle the critical topic of risk management, providing you with practical strategies to navigate the uncertainties of the financial world. And because no exploration of financial psychology would be complete without addressing the emotional roller coaster that often accompanies money matters, we'll equip you with the tools and insights needed to make rational, level-headed decisions even when emotions run high.
Let's face it, we love a good success story. We're drawn to tales of entrepreneurs who built empires from scratch and investors who struck gold. But what often gets lost is the role of luck, the unpredictable force that can catapult us to unimaginable heights or send us tumbling down. In The Psychology of Money, Morgan Housel reminds us that luck plays an undeniable role in financial outcomes. It's a humbling realization, especially in a society that often equates wealth with merit. We tend to attribute success to hard work and intelligence, overlooking the fortunate breaks that paved the way. Sometimes being in the right place at the right time can make all the difference. Remember those captivating stories of overnight success we talked about? Housel calls them tales. Those rare, improbable events on the outer edges of the probability curve. They're the outliers, exceptions to the rule, yet they influence our perceptions of success. We see a college dropout turned tech billionaire, and the traditional path seems mundane. We hear about a lottery winner and fantasize about our own lucky break. But these stories are the exception, not the rule. Focusing on tales distorts our understanding of risk and reward. We neglect common incremental gains from disciplined saving and investing. It's like playing the lottery and expecting to win the jackpot. The odds are against us. Housel encourages us to focus on the power of the average. By acknowledging outliers, we can make more rational financial decisions.
Risk and reward are inseparable companions in the world of finance. You can't have one without the other. The higher the potential reward, the greater the risk involved. It's a fundamental principle that often gets lost in the pursuit of quick riches.
Housel emphasizes the importance of understanding our own risk tolerance, a crucial factor often overlooked in the excitement of investment opportunities. Are we comfortable with the possibility of significant losses in exchange for the potential of high returns, or do we prefer a more conservative approach?
There's no right or wrong answer when it comes to risk tolerance. It's a personal decision based on our individual circumstances, financial goals, and emotional capacity to handle market fluctuations. The key is to align our investment strategies with our risk appetite, ensuring that we're not taking on more risk than we can comfortably handle.
Remember, investing is a marathon, not a sprint. By adopting a long-term perspective and making calculated decisions based on our risk tolerance, we increase our chances of weathering market storms and achieving our financial goals over time.
Imagine a snowball rolling down a hill. At first it's small, almost insignificant, but as it gathers snow, it grows larger and larger, gaining momentum with each rotation. That's the power of compounding in action. A force so potent, yet often misunderstood, that Albert Einstein reportedly called it the eighth wonder of the world.
In The Psychology of Money, Morgan Housel brilliantly demystifies this concept. Compounding, he explains, is the process of generating earnings on your earnings. It's like a financial snowball effect where your money makes money, and then that money makes even more money. It's the ultimate example of exponential growth in action.
Think of it this way. If you invest $100 today at a 10% annual return, you'll have $110 next year. But here's where the magic happens. The following year, you're not just earning 10% on your initial $100. You're earning 10% on $110 and so on.
We live in a world of instant gratification, where we expect everything from our online orders to our news feeds to be delivered with lightning speed. But when it comes to investing, patience isn't just a virtue, it's a superpower.
Housel reminds us that compounding is a game best played by those who understand the value of delayed gratification. It's about resisting the urge to chase quick profits, to jump from one hot stock to another, seeking instant riches. It's about staying the course, trusting in the slow and steady accumulation of wealth over time.
Think of it like planting a tree. You wouldn't dig it up every few days to see if it's growing, would you? No, you'd give it time, nourishment, and the space to flourish. Investing is no different. It requires patience, discipline, and the willingness to let the magic of compounding work its wonders.
But patience isn't about passivity. It's about active waiting. It's about staying informed, making adjustments when necessary, and weathering the inevitable market storms with a long-term perspective. Section 3. Small habits, big outcomes, consistency over intensity.
Consistency trumps intensity in building wealth. You don't need to win the lottery to achieve financial security. Small, consistent actions over time lead to success.
Develop good financial habits for long-term impact. Section 1. The price of freedom, money's true value.
We often hear that money can't buy happiness. And while that's true to some extent, Morgan Housel argues in The Psychology of Money that money can buy something equally valuable: freedom. It's not about amassing wealth for wealth's sake. It's about using money as a tool to design a life that aligns with our values and aspirations.
Think about it. Financial security provides us with options. It gives us the freedom to pursue our passions, to take risks, to say yes to opportunities that excite us and no to those that don't. It's about having the flexibility to work because we want to, not because we have to.
When we're constantly worried about paying the bills or making ends meet, our choices become limited. We're forced to prioritize short-term needs over long-term goals, sacrificing our dreams on the altar of financial stability. But with a solid financial foundation, we can break free from these constraints and create a life of greater autonomy and fulfillment.
Section 2. Time well spent, the ultimate currency.
In a world that often equates success with material possessions, it's easy to forget that the most precious resource we have is time. Housel reminds us that time, unlike money, is a finite resource. We can always earn more money, but we can't earn more time.
This realization shifts our perspective on wealth. It's not just about how much money we accumulate, but how we spend the time we have. Are we trading our precious hours for a paycheck, only to spend those earnings on things that bring us fleeting joy? Or are we investing our time in experiences, relationships, and pursuits that bring us lasting fulfillment?
Financial freedom, then, becomes less about accumulating wealth and more about reclaiming our time. It's about having the financial security to make conscious choices about how we spend our days, weeks, and years. It's about aligning our spending with our values, prioritizing experiences over possessions, and investing in our well-being.
Building your freedom fund, investing in your future.
Achieving financial freedom isn't about winning the lottery. It's about making intentional choices today. It's about building a freedom fund, a financial cushion that empowers us.
This starts with developing healthy financial habits, living below our means, saving consistently, and investing wisely. Remember, financial freedom is a journey, not a destination. Section 1. Navigating the unknown, embracing uncertainty in finance.
The world of finance is inherently uncertain. Market fluctuations, economic downturns, and unforeseen events can disrupt even the most well-laid financial plans. Yet many of us crave certainty, seeking guarantees and clinging to predictions in a realm where the only constant is change.
In The Psychology of Money, Morgan Housel encourages us to shift our mindset from seeking certainty to embracing uncertainty. He reminds us that we don't need to predict the future to achieve financial success. We need to be prepared for a range of potential outcomes. It's about acknowledging that we can't control the markets, but we can control how we respond to them.
This shift in perspective requires a healthy dose of humility. It's about recognizing the limits of our knowledge and accepting that we can't predict every twist and turn in the financial markets. It's about letting go of the illusion of control and embracing the reality that uncertainty is an inherent part of the game.
Section 2. The margin of safety, building buffers for unexpected storms.
Imagine you're building a bridge. Would you add a margin of safety to handle unexpected loads and potential stresses? Our financial lives need buffers to withstand unexpected financial storms.
Housel emphasizes building margins of safety into our financial plans. This means saving more than we think we need and investing conservatively. It's about creating a financial cushion that provides peace of mind.
Section 3. Avoiding ruin, the paramount rule of risk management.
In finance, it's not just about winning. It's about staying in the game. Housel emphasizes avoiding ruin as the key rule. Protect your financial well-being from catastrophic losses, understand potential downsides, and avoid excessive risk. Even a small chance of catastrophic loss can be devastating. Prioritize long-term security over short-term gains. Remember, slow and steady often wins the race.
The emotional roller coaster, how feelings shape financial choices.
When it comes to money, we're not always rational. Emotions like fear, greed, and panic cloud our judgment. Morgan Housel dissects this in The Psychology of Money.
We've all been there. A hot stock tip fuels our FOMO, or panic leads us to sell at a loss.
These reactions are ingrained in our psychology. Our brains prioritize immediate rewards over long-term well-being. This fight-or-flight response can harm our investments.
Recognizing emotional influence is key to rational choices. Section 2. Fear and greed, the two wolves within.
In finance, fear and greed are the two wolves vying for control. Fear whispers tales of market crashes, urging us to retreat. Greed tempts us with visions of wealth, urging bigger risks.
Both can lead us astray if left unchecked. The key is finding a balance. Develop a long-term perspective to weather market fluctuations.
Mastering your emotions, rational decision-making in finance.
Taming the emotional rollercoaster of finance isn't about becoming cold and calculating robots. It's about developing self-awareness and strategies to mitigate their influence. Become the master of your emotions, not their slave.
Focus on what you can control. We can't predict market movements, but we can control our savings rate and investment choices.
Develop a long-term perspective. Time is the investor's greatest ally.
Seek professional financial advice for an objective perspective. Investing in financial education and expert guidance is key.
The Psychology of Money, a holistic approach to finance. Our relationship with money is more profound than tracking numbers or chasing investment fads. It's about understanding the interplay between our minds, emotions, and financial well-being. Housel weaves behavioral economics, personal finance, and wisdom for a holistic framework. Financial success isn't just about intelligence, education, or work ethic. It's about a healthy relationship with money, rooted in self-awareness and emotional intelligence. Understanding psychological forces helps us make informed, intentional financial choices. Money is a tool for freedom, purpose, and well-being. The Psychology of Money is a roadmap to a richer, more fulfilling life. Section 2. Key takeaways, putting knowledge into action. Throughout this exploration of Housel's work, we've encountered numerous insights that challenge conventional financial wisdom and empower us to make smarter decisions with our money. Let's recap some of the key takeaways that can guide us on our journey to financial well-being. First and foremost, remember the role of luck and risk. Acknowledge that while hard work and smart choices are essential, unforeseen events and market fluctuations can significantly impact our financial outcomes. Embrace uncertainty, build margins of safety, and prioritize avoiding catastrophic losses over chasing outsized returns. Embrace the power of compounding. Cultivate patience, consistency, and a long-term perspective. Start investing early, even if it's with small amounts, and let the magic of compounding work its wonders over time. Remember, time is the investor's greatest ally. Shift your focus from accumulating wealth to cultivating freedom. Define what financial freedom means to you and align your financial decisions with those aspirations. Prioritize experiences, relationships, and pursuits that bring you joy and fulfillment, recognizing that time, not money, is your most precious resource. Section 3. Building a brighter financial future. Your journey begins now. As we conclude our exploration of the psychology of money, remember that knowledge without action is meaningless. It's time to take the insights we've gained and translate them into positive changes in our financial lives. Start by examining your own relationship with money. What are your beliefs, your habits, and your emotional triggers? Identify areas where you can make improvements, whether it's saving more consistently, investing more wisely, or managing your emotions more effectively. Don't be afraid to seek professional guidance. A financial advisor can provide personalized advice, help you develop a sound financial plan, and hold you accountable to your goals. Remember, investing in your financial education and seeking expert support are wise investments in your future well-being. Building a brighter financial future is a journey, not a destination. It's about making conscious choices, developing healthy habits, and staying committed to your long-term goals. Embrace the insights from the psychology of money and embark on your path to financial freedom, security, and fulfillment.